This conference will now be recorded.
Okay, part 3 in my series on tax planning. This one gets a little broader. It deals with retirement planning, tax planning, maybe a little estate planning. So let me share my screen here, go through some of these slides. A high-tech video here. This one, as I mentioned, covers those 3 areas and highlighted there. It's primarily going to focus on the Secure Act, which actually happened in 2019, but because it focused on the retirement side of things, I'm going to cover some of the highlights of it. RMD age was raised from 70.5 to 72, so that's the time in which in your traditional IRA or other pre-tax retirement accounts, you're required to at least take a minimum distribution from that account so the government can get their taxes. Another change was that they got rid of the age limit that you could contribute to a traditional IRA. Used to be 70.5. Now you can make a contribution of around 7,000 at any age over 70.5, only if you have that much or more in earned income. While not part of the Secure Act, and as I've mentioned in other video series, the QCD allows you to give to charity and not have to pay taxes on that. One idea is to give one check per year to your church or favorite charity direct from your IRA account, especially if you don't plan to itemize your deductions. Another major change enacted by the Secure Act was to create some new 529 plan rules. So you can use up to $10,000 in your lifetime for student loan repayments. It removes the 10% retirement account penalty for up to $5,000 under 59.5 for childbirth or adoption. It changes a little how inheritors need to take funds from a retirement account. There's a new 10-year rule that basically requires all inherited IRAs, Roth IRAs, etc., to be distributed within a 10-year period of death. It does have some exemptions. Under the old rules, you could stretch it out over really the inheritor's lifetime. Now, the new rule or the 10-year rule says you don't have to take a distribution every year, but by the 10th year, it needs to be ended. Your objective is still to reduce your taxes and take advantage of tax deferral as long as possible. Then there is a 5-year rule to be aware of. So talk to your advisor or tax advisor, kind of make sure you're following those rules if you end up inheriting an IRA or plan to pass one on. This changes some of the strategies that we used to teach. So this kind of shows the typical path in the past. If you now leave your retirement funds to your spouse, they still must take distributions over their lifetime. Showing a depiction here of 8 years later, you leave it to the beneficiaries, and then they had the 10-year rule. So there might be new strategies to inherited IRAs that potentially create a spread of tax liability over more brackets or more years. Back to the example, your spouse dies 8 years later. During their 8 years of life, your spouse and beneficiaries who have 10 years could be taking distributions, and then after the spouse dies, maybe have a new 10 year. So basically takes the 10-year rule and spread it out over 18 years, not 10. So being proactive could make a difference for those that you're trying to pass it on to. And then of course a Roth IRA, if it's inherited, is not taxed during that period of time, similar to the benefit you had. Tax bracket management, it's basically just trying to figure out who's going to pay the most tax, you or the next generation, and then strategizing around that. First steps to review your marginal tax rate, your beneficiaries' marginal tax rates each year, see what makes the most sense. Something to remember is even if no changes are made to tax rates, like with Biden being elected, in 2026, the law says we go back to the older, higher rates. So when making your plan, you need to remember that. Let me say it again, the tax laws call for a sunset in 2026. So the law says we go back to the older, higher rates automatically in 2026. For some people, that means a large withdrawal could mean what is today taxed at 24% could be taxed in 2026 at 33%, which obviously is a much higher rate. So how can you make the mathematics of a conversion work for you? Here's some things to consider. There's bullet points there. And then again, target the conversion in some of those lower rates, which surprisingly can, like a married couple can earn up to $330,000 roughly and still be in a 24% tax bracket. This may make Roth conversions more appealing. Some other reasons: tax brackets could rise in the future, like we've already mentioned. Your account value might be down from a drop in the market. That might be a good time to do it. Some benefits of a conversion: they lower your taxable income, they get tax-free growth. Roth IRAs have no RMDs, so they don't make you take money out of it at a certain age. And it could be good for beneficiaries that also get that tax-free growth for a period of time. So in our reviews that I try to do, we have on our list to review beneficiaries and make sure they don't need to be updated, which obviously ties into some of these strategies. Whatever strategy we end up evaluating, we can coordinate it with your tax preparer. So as a recap, here's some key takeaways. Read it there. Thank you. Again, this is part 3. If somebody can benefit from it, feel free to send this out. And then there's some disclosure information. Hope you have an awesome day. Appreciate you. Let me know if you need anything.